Tesla stock is currently trading intraday at $421.77, pushing up by 1.42% in this Tuesday afternoon session on June 2, 2026. While the broader market watches this steady upward drift, a subtle but massive undercurrent is quietly reallocating institutional funds behind the scenes. This isn't just about daily green candles or short-term retail excitement. The unexpected angle caught by sharp market analysts today is a profound structural shift in who is controlling the float. While retail investors are busy debating single-day delivery numbers on social platforms, massive institutional players are executing large block orders through major individual brokerage platforms and algorithmic pipelines, trying to capture positions before a much larger structural macro event occurs later this year. The immediate assumption is that this 1.42% move is just standard market noise, but the tracking data reveals an unusual concentration of block trades during the opening hour that signals a coordinated accumulation phase by systematic funds. The common ground shared by most market onlookers is simple. People look at the Tesla stock price and automatically assume it moves entirely on the latest social media post from its leadership or the singular narrative of global electric vehicle delivery tallies. This baseline belief tells you that if car sales flatten, the asset must suffer. However, the contrarian reality unfolding right now is that the underlying valuation is separating itself from automotive manufacturing metrics entirely. Wall Street is increasingly treating this asset as a hybrid technology and energy infrastructure conglomerate, which explains why traditional automotive valuation models continue to fail so spectacularly. When you analyze trading patterns on comprehensive options desks or through interactive brokers platform networks, you see a massive spike in long-term call options that completely defies the flat auto demand headlines. Investors who view this purely as a car company are fundamentally miscalculating the asset's floor price because they are measuring the wrong variables. When evaluating recent price actions and daily swings, the technical indicators paint an incredibly tense picture between technical resistance and aggressive institutional support. Over the past few weeks, trading volumes have consistently spiked on days where the stock dipped below its moving averages, revealing a firm accumulation floor. This institutional activity suggests that large portfolio managers, including those who direct assets into structured vehicles like the Schwab Intelligent Portfolios or balanced mutual funds, are actively rebalancing their exposure. The daily volatility we are observing today, with the stock moving between an intraday low of $413.65 and a high of $423.47, shows a classic tug-of-war. Sellers are trying to cap the asset near the psychological resistance level, while automated buy programs are triggered the moment the price retreats toward the morning support lines. This specific type of volume distribution implies that institutional hands are content to absorb sell orders quietly without chasing the price too high too quickly, which is a classic hallmark of smart accumulation. The macroeconomic pressures currently pressing down on the broader market are impossible to ignore, yet the price resilience stands out as a unique anomaly. High interest rates globally have historically acted as a major drag on expensive consumer purchases, which logically should hurt automotive financing. This expectation created a massive short thesis over the past year, but the reality is that the company's balance sheet, packed with billions in cash and minimal high-interest debt, has turned the macroeconomic headwind into a competitive advantage. While legacy competitors are forced to scale back their capital expenditures because borrowing costs are prohibitive, this organization is funding massive infrastructure expansions, such as the newly active lithium refinery operations in Texas, directly out of free cash flow. This means that the expectation of a high interest rate slowdown slowing expansion has collided with the reality of an unassailable capital position. Sector momentum has also shifted dramatically in recent weeks. For a long period, technology stocks were leading the market single-handedly, while industrial and automotive sectors lagged behind. Now we are seeing a convergence where computing power, energy storage, and industrial manufacturing are merging into a single sector asset class. Analysts using advanced interactive brokers trading software have noted a high correlation between premium semiconductor movements and this specific trigger, suggesting that the market is pricing the company far more like a hardware computing platform than a metal stamping vehicle producer. This shift in sector classification by automated trading systems alters how the stock behaves during index rebalancing periods, causing it to catch tailwinds from tech sector inflows even when broader industrial indicators are flashing red. Comment below how many shares of Tesla stock you currently hold in your individual brokerage account right now, and let me know if you are actively buying more at this current level or waiting for a deeper pullback to add to your position. To truly understand how we arrived at this structural inflection point, it is essential to look at what the underlying company actually does and how its core business model operates. At its heart, the firm designs, manufactures, and sells high-performance fully electric vehicles, utility-scale solar energy generation systems, and massive commercial and residential battery storage products. Its unique business model bypasses the traditional third-party dealership network entirely, opting instead for a direct-to-consumer sales and service model that allows the company to maintain absolute control over pricing, brand consistency, and customer data acquisition.
Furthermore, its vertical integration is unparalleled in the industrial world. They don't just assemble components sourced from global suppliers, they manufacture their own battery packs, write their own operating system code, design their own custom artificial intelligence microchips, and operate a proprietary global fast-charging infrastructure network that has effectively become the gold standard for the entire transportation industry. Looking back at past performance and older financial reports, the company's financial evolution provides a clear roadmap for its current market premium. Years ago, critics continuously pointed to negative cash flows and a high reliance on regulatory credit sales to achieve GAAP profitability. However, as production lines scaled across multiple global manufacturing hubs, the cost per vehicle plummeted, driving industry-leading operating margins that shocked traditional manufacturers. Older quarterly statements from previous years show a steady transition from a capital-consuming entity to a capital-generating machine, with free cash flow expanding to a point where the firm could completely self-fund its massive computing clusters without relying on secondary equity offerings. This historical track record of defying bankruptcy predictions and scaling complex manufacturing processes against all logical odds is exactly why a permanent premium is baked into the stock price today, creating a deep psychological buffer among long-term investors. When you look at online investing apps like the Robinhood app or analyze standard portfolio allocations inside a Fidelity brokerage account, you find that retail interest remains incredibly sticky, acting as a permanent liquidity backstop. Even during periods of severe macroeconomic pressures, fractional share buyers and regular retail accounts utilizing self-investing strategies tend to hold their positions rather than panic sell. This unique retail loyalty, combined with expanding institutional ownership across standard retirement products and Fidelity Investments vehicles, creates a highly unusual market structure where the available trading float is constantly constrained. When supply is locked up by both passionate long-term retail accounts and systematic institutional index trackers, any sudden surge in positive volume can create massive, explosive upward price movements because there simply are not enough shares available for short sellers to cover their positions easily. Looking ahead toward the future outlook, several distinct scenarios and catalysts are beginning to take shape, each carrying a unique balance of risk and immense opportunity. The primary near-term catalyst that the entire market is focusing on is the eventual commercial monetization of autonomous driving software and the widespread deployment of network-driven robotic transport services. The market expectation is that full autonomy is a binary switch that will instantly add trillions to the valuation the moment a regulatory approval is signed. The reality, however, is likely to be a highly fragmented region-by-region rollout, characterized by localized regulation battles, intense mapping updates, and gradual consumer trust building. This gap between the clean, immediate expectation and the messy, iterative reality will likely create significant volatility windows where impatient capital exits the stock, presenting distinct accumulation opportunities for disciplined investors managing their wealth through self-investing or sophisticated online investment strategies. Another massive yet frequently undervalued future catalyst lies in the energy storage business segment. As global grid infrastructures face unprecedented strain from the compounding electricity demands of massive artificial intelligence data centers, the necessity for utility-scale battery deployment is growing exponentially. The outputs for commercial energy storage products are already booked out years in advance, representing a highly predictable, high-margin revenue stream that is completely decoupled from consumer vehicle demand cycle trends. The expectation is that auto sales will always dictate the company's financial health, but the reality over the next few years could show the energy storage division growing to represent a massive percentage of total corporate net income, completely transforming the fundamental investment thesis for anyone holding the asset across major financial platforms. On the risk side of the ledger, intense international competition remains a persistent structural threat that cannot be overlooked. Lower-cost manufacturing ecosystems abroad are producing highly competitive electric options at price points that are incredibly difficult to match without eroding corporate operating margins. If the global consumer market shifts entirely toward a low-margin price war, the company will be forced to choose between defending its volume market share or preserving its premium brand pricing power. This expectation of a margin squeeze is already highly discussed among analysts reviewing data on specialized interactive brokers trading platforms, and any signs of prolonged pricing degradation in key regional markets will immediately test the stock's current premium multiple. Furthermore, navigating complex international supply chains for critical battery raw materials present ongoing operational risks that require continuous capital investment to mitigate. When we synthesize these moving parts, the central insight becomes undeniably clear. The market's expectation is structured around a highly volatile, headline-driven automotive manufacturer struggling against global consumer slowdowns and executive distractions. The underlying reality, substantiated by intense block trading volume, absolute capital self-sufficiency, and a rapidly scaling industrial energy storage business, is that this company is systematically building a closed-loop technology ecosystem that traditional analysts simply do not know how to accurately model. The contrast between what the general public believes they are buying on basic investing sites and what institutional accumulators are quietly building into their long-term portfolios through advanced individual brokerage services is where the true market discrepancy lies. It is this exact tension between narrow expectations and a vastly broader corporate reality that continues to make this asset one of the most polarizing, yet fundamentally resilient fixtures in the entire modern financial landscape, maintaining an authoritative position that forces every serious global investor to pay close attention. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.